What does financial freedom actually mean? Is it having $1 million, owning a luxury home, or simply never needing to work again? The surprising answer is that wealth and financial freedom are related, but they are not the same thing.
Someone can have a huge income and still feel financially trapped, while someone with far less wealth can experience much more freedom.
To understand financial freedom, we first need to separate 4 concepts: income, wealth, expenses, and financial obligations. A high income tells you how much money comes in. It does not tell you how much freedom that money creates. Imagine someone earning hundreds of thousands of dollars a year, but spending almost everything they earn.
If their lifestyle rises as quickly as their income, their dependence on that income may remain extremely high.
They may look rich from the outside, but financially, they are still running to maintain their lifestyle.
This is why financial freedom cannot be measured by income alone.
At its core, financial freedom means having enough financial resources and flexibility that your survival is no longer completely dependent on your next paycheck.
The real issue is dependence. How much of your life must you exchange for income just to keep your current life running?
Financial freedom increases when your assets and financial systems can support your life without requiring every hour of your labor.
This is where assets become important. Assets can potentially produce income or appreciate while you are doing something else. The more of your essential expenses can be covered by sustainable non-labor income, the closer you move toward financial independence.
But passive income is not automatically permanent or risk-free.
A stronger form of financial independence comes from resilience, multiple assets, manageable expenses, liquidity, and controlled risk. Financial freedom is not simply having investments. It is having enough financial resilience to survive when one part of your system fails. Unexpected unemployment, medical expenses, market crashes, family emergencies, and economic downturns can all test whether your freedom is actually real. That is why liquidity matters. Money you can access quickly can protect long-term investments from short-term emergencies.
A person can also be wealthy on paper while carrying enough debt to remain highly financially vulnerable.
This is why net worth matters more than income when evaluating overall wealth. Net worth is essentially what you own minus what you owe.
Two people can look equally wealthy while having completely different levels of financial security. One of the biggest enemies of financial freedom is lifestyle inflation, earning more and immediately finding new ways to spend more. If every raise creates a more expensive lifestyle, higher income may increase comfort without significantly increasing freedom. Sometimes the fastest path to freedom is not earning dramatically more. It is reducing how much money your life requires. A lower-cost lifestyle can reduce the amount of wealth you need to achieve genuine independence. There is also another dimension of freedom: location and lifestyle flexibility. For many people, the most valuable form of financial freedom is not luxury. It is control over their time. It can mean choosing when to work, where to live, what projects to accept, or simply having more time for people who matter.
And then there is psychological freedom, which money alone cannot guarantee.
If you constantly fear losing what you have, a larger bank balance may not automatically create a greater sense of freedom. True freedom includes the ability to stop constantly monitoring money, because your financial system is designed to withstand uncertainty. Freedom also depends on your responsibilities. Supporting family members or carrying major obligations can change what financial independence means for you.
Financial freedom is therefore personal. The amount of money required depends on the life you actually want to live.
There is no universal number that makes everyone financially free. The target depends on expenses, assets, risk, time horizon, and lifestyle.
Someone who needs a modest amount to live comfortably may reach independence much sooner than someone whose lifestyle requires enormous annual spending.
Financial independence is better understood as a spectrum than a finish line.
You can become less financially fragile long before you become completely independent from work.
From a financial planning perspective, the strongest foundation combines liquidity, manageable debt, sustainable spending.
The goal is not to eliminate every financial risk. It is to build a system strong enough to absorb reasonable risks without destroying your life.
So does having a lot of money mean you are financially free? Not necessarily.
Money can buy options, reduce stress, and create opportunities. But wealth becomes freedom only when it reduces your dependence on circumstances you do not control. The deepest form of financial freedom is not being able to afford everything. It is being able to say no to what you do not want without putting your financial future at risk. Financial freedom is not a number in your bank account. It is the ability to control more of your time, choices, and future without being forced by money.